$600 billion.
In 2021, Mark Zuckerberg made one of the biggest gambles in corporate history.
Our company is now Meta.
But after pouring $70 billion into the metaverse, Zuck is finally pulling the plug, with reports suggesting he's cutting spending in the division by a third.
If you're trying to make sense of that move, it's not about just stopping something that didn't work. It's about realizing that even after all that time and money, it still didn't turn into something people actually cared about using. And that's a tough outcome to accept at that scale.
What's crazy about this story is not just how badly Meta's strategy backfired, but Zuck's solution to it, which is to spend 10 times more money on another moonshot.
How much are you spending, would you say, over the next few years?
$600 billion through 28.
When you throw $70 billion at the wall, you'd hope something sticks. And for Zuck, that was the Ray-Ban Meta smart glasses, which are basically all the company has left to run with.
The way that just sounded, it's like you watched something flop and said, you know what? Let's just spend even more this time. That sounds crazy, right? Like you just took that kind of an L and now you doubling down even bigger without knowing how this project's gonna play out? What you're really seeing isn't them trying to repeat the same move blindly. It's them trying to rework the idea into something that fits how people actually behave. Walking away would mean losing everything they already invested. So the focus shifts to making it usable in a way the market might accept.
Unlike the bulky VR headsets that isolate you from the world, people are actually wearing these. They can show notifications, capture photos and video, play audio, and let you interface with AI, all while keeping your eyes in the real world. Even legendary tech reviewer Marquez Brownlee praised how seamlessly they blend into everyday life.
The rate of improvement is kinda insane.
The market data is promising. Meta has sold over 2 million units since launching, now commanding an 80% market share in the smart glasses category.
The part that stands out here is this isn't something that you have to stop your day to use. It fits into what you're already doing, and when something feels that natural to wear, it starts to move from being a gadget to something people actually keep around. That's usually when it has a better chance of sticking long term.
And the ambition here is scaling fast. Meta and its partner Luxottica are looking to achieve 5 times sales growth next year, with 10 million units projected to ship in 2026. Part of this push also involves opening more retail locations to let customers experience them. Now, the vision for smart glasses all goes back to AI. While ChatGPT and Gemini fight to win the consumer market, Meta is betting chatbots aren't the long-term venue of how we'll use AI.
What this starts to look like is Meta doesn't even want you opening an app to use AI anymore. They want it already built into whatever you're doing. That's a different type of move because now it's not something you go to. It's something that's just always there. And once it's positioned like that, it changes how often you even think to use it in the first place. Here's something you gotta pay attention to. They're not trying to win the same way OpenAI and Google are right now. By going this route, Meta basically is trying to separate itself from the crowd instead of competing head on in the same space. And that's a smart play if it actually lands.
Zuck's bet is that having the right hardware first is going to win the AI war.
Our theory is that glasses are the ideal form factor for personal superintelligence because it's the only real device that you can have that can see what you see, can hear what you hear, can talk to you throughout the day, and can generate a UI in your vision in real time.
What he's laying out here actually makes sense when you think about how people interact with technology throughout the day. But the real question is whether the idea holds up against the tools and habits people are already used to. Because having the right concept is one thing. Actually getting people to change what they rely on is a completely different challenge.
But Meta's AI tech that's meant to power these glasses is far behind competitors. The company's large language model Llama consistently ranks below the competition. On top of this, there have been murmurs about chaos and delays inside Meta's AI division. Yann LeCun, Meta's longtime chief AI scientist, just left. The superintelligence team, as it's called, is now working on a new frontier AI model codenamed Avocado, which is rumored to be closed source instead of open like Zuck always promised.
You know what the irony is, guys? You can call it llama, avocado, whatever you want, but you don't escape the underlying constraints you were dealing with in the first place. Those constraints like data limitations, scaling challenges, hallucinations, and compute costs are still there whether you like it or not. That's where someone like Yann LeCun comes in, because people at that level don't just leave over surface level changes. He likely stepped back because of deeper issues like disagreements on direction, limits in the technology, or how the system was being pushed beyond what it can reliably handle.
Unless it can catch up in the model wars, Meta's glasses will be worthless, especially when more advanced AI companies like OpenAI and Google are pursuing their own hardware devices. If you've been following any kind of market news, you know that every big tech company is sinking vast sums into AI. But Meta's AI spending is way riskier than it is for other tech giants. Meta projects its AI spending to be $70 billion for 2025 alone.
I don't know if y'all caught that, but they tried going a whole different route with the hardware. And now they're right back competing with the same people they were trying to avoid. At that point, it's not just about the idea anymore. It comes down to whether they can actually keep up.
That's equivalent to the company's entire spend on the metaverse in 5 years. And next year, it's only going up, with projections north of $100 billion, as Meta chips away at its pledge to spend a whopping $600 billion over the next few years. This spending spree has included $100 million contracts to lure researchers away from competitors, the acquisition of Scale AI, and a massive $27 billion data center in Louisiana.
You know what, guys? That's a lot of money. Like a lot of money being thrown at this all at once. Coming off a 70 billion miss like that, it feels like they're moving fast just to catch up on something they're already behind in. At that point, it starts to feel less like a plan and more like they're trying to recover fast. Because once they committed to the hardware, they locked themselves into needing the software to make it work. The tough part is, by the time they got to this point, other companies were already ahead on that side. So now they're trying to close a gap that's already there.
Now, when it comes to players like Google, Microsoft, Oracle, and Amazon, they have a safety net in their cloud businesses. These companies all have multi-$100 billion backlogs from customers who want to rent their AI data centers. These companies spend billions on NVIDIA chips, and they know exactly how they're going to get paid back. Meta, on the other hand, does not have a cloud business. They're spending like a cloud provider without the cloud revenue. They have less than half the cash reserves of Google, Microsoft, or Amazon, and they're burning roughly 65% of their operating cash on CapEx.
See, that right there puts them in a tight position, because they spending all this money without that same kind of backup coming in. If that doesn't start paying off, they end up relying heavier on ads or product sales just to make it back. And that's where things can start getting stretched real fast.
A much higher proportion than Google or Microsoft. Every dollar that Meta spends on AI chips has to be recouped by either making you look at more ads or selling you smart glasses. This is basically an all-in poker move with the company credit card. And investors are skeptical that Zuck can pull this off. As they have many times in the past, investors are scared about Zuck's plans.
What would you do in his position right now? I'll tell you how I see it. Falling behind isn't the problem. It's how you move once you realize you are. Because rushing everything just to catch up can make things worse. This is what I would do, Kev. I'm slowing it down just to get it right, instead of throwing money at everything at once. If you build a product strong enough, it can carry you ahead on its own, and you wouldn't have to force your way there.
After Meta's Q3 earnings, the stock took a nosedive. It's down over 15% from its all-time highs because investors are worried about this big AI spending. When the world moved from desktop to mobile, people thought Facebook was dead. Then Zuck practically monopolized ads in that medium. When Snap and TikTok came in, Zuck cloned them and won. And after Apple made sweeping privacy changes, Zuck still came out on top.
Mark Zuckerberg's track record does matter because he's gotten out of bad spots before. And that's part of why people still take his bets seriously. But just because Mark Zuckerberg has won through past shifts doesn't mean every new gamble is gonna play out the same way.
Overall, Meta has a cash machine for a core business. It generated $51 billion in revenue just last quarter, growing 26% year over year. Right now, Meta is trading at the cheapest valuation of the Magnificent Seven stocks because uncertainty creates upside. But if Zuckerberg doubles down on another moonshot that doesn't pay off, it could all come crashing down.
At this point, it really comes down to how this plays out because you can see both sides of it. It could either turn into something huge or it could end up being another expensive lesson. And with that much money on the line, there's not really a middle ground. So now it's less about what they're trying to build and more about whether they got the timing right. Because once you start seeing how these moves connect across companies, it's hard to ignore.